Hello, everyone. Welcome to another episode of iTech. Bitcoin has long been seen as a revolutionary financial asset, the first decentralized currency operating outside the control of any central authority. Its rise has been extraordinary, but the recent price crash has raised many questions about its future stability and viability. Today, we'll take a deep dive into the causes behind this crash, how it has affected the broader market, and what the future might hold. This analysis is based on technical indicators, macroeconomic data, and expert insights, so let's get started. Let's start with the basics. Bitcoin was introduced in 2009 by a mysterious figure, or group, known as Satoshi Nakamoto. Its creation was a direct response to the 2008 global financial crisis, offering an alternative to traditional fiat currencies controlled by central banks. Unlike traditional currencies, Bitcoin is decentralized, no single authority controls it. Finite supply, only 21 million BTC will ever exist, making it deflationary. Trustless system, transactions are verified by a network of nodes through cryptography and the proof of work, POW, consensus mechanism. Over the years, Bitcoin has become a store of value, often referred to as digital gold. Its price movements have mirrored those of commodities like gold, especially during periods of economic uncertainty. However, Bitcoin's high volatility has always been a challenge, and the recent price crash is a stark reminder of this. In this presentation, we'll explore the underlying causes and what this means for the future. This chart illustrates Bitcoin's price trajectory over the past year. In January 2025, Bitcoin hit an all-time high of approximately $102,405, driven by institutional adoption, ETF approvals, and increasing demand from retail investors. However, since that peak, Bitcoin has lost nearly 20% of its value, now trading at around $83,722 as of March 2025. Notice the steep drop-off after mid-January. This wasn't a gradual correction, it was a sharp, panic-driven sell-off. Technical analysts had identified $80,000 as a key support level. Once that was breached, automated liquidations and stop-loss orders accelerated the decline. We'll now explore the immediate causes behind this sharp reversal. Let's break down the key events that triggered the crash. Regulatory actions. In early January, President Trump signed an executive order to create a strategic Bitcoin reserve. While this was initially seen as bullish, the lack of clarity surrounding the reserve's management raised uncertainty. Investors feared that the government could manipulate Bitcoin supply or use it to control market dynamics. Introduction of tariffs. New tariffs imposed on imports from China and Europe created economic uncertainty. This led to a flight from high-risk assets like Bitcoin into more stable assets like the US dollar and treasury bonds. High leverage in the market. In the months leading up to the peak, many investors used margin and leverage to maximize profits. When the price began to drop, margin calls forced liquidations, creating a cascading effect that intensified the selling pressure. Beyond immediate market events, broader economic factors have played a significant role. Inflation and interest rates. Inflation in the US and Europe remains stubbornly high, around 4%. Central banks have maintained high interest rates to curb inflation. This makes holding risk assets like Bitcoin less attractive because yields on safer investments, like bonds, are more appealing. Geopolitical tensions. The ongoing conflict in Eastern Europe and trade disputes between the US and China have created uncertainty in global markets. Institutional investors tend to de-risk during geopolitical instability, and Bitcoin has not been spared. US dollar strength. A strong dollar generally correlates with weakness in Bitcoin. The DXY index, which measures dollar strength, has climbed steadily since early January, putting downward pressure on Bitcoin. New investors have been disproportionately affected. Many retail investors entered the market at or near the peak, following hype around Bitcoin ETFs and bullish market sentiment. When prices started falling, many of these investors panic sold, locking in significant losses. According to Reuters, over 60% of new wallets created since November 2024 are now at a loss. This has created a sense of disillusionment, with some investors questioning whether Bitcoin can still deliver long-term returns. From a technical standpoint, Bitcoin initially found support at $80,000, but once that level failed, the next key support level at $75,000 quickly came into play. If Bitcoin breaks below $73,000, the next technical target would be around $65,000, a major psychological level. Analysts are watching the 200-day moving average closely. If Bitcoin falls below this trend line, it could signal a deeper correction. Market sentiment has turned extremely bearish. The crypto fear and greed index fell to 15, extreme fear. Historically, extreme fear periods have led to price bottoms, but this time, the market's uncertainty around regulation is keeping sentiment negative. Comparison with previous cycles. We've seen this before. The 2017 bull run ended with an 84% decline in 2018. The 2021 cycle saw a 50% correction before a recovery. If history repeats, we could see a deeper correction before a recovery begins. Broader crypto market impact. Ethereum, Solana, and XRP have also dropped. Ethereum lost 18% since January. Solana fell 22% from its January high. The total crypto market cap has declined by 15% since the start of the year. Institutional response. Tesla's Bitcoin holdings are down $300 million in value. MicroStrategy's CEO stated they will continue to hold despite the decline. Regulatory environment. The SEC has increased pressure on exchanges to comply with new anti-money laundering measures. Future outlook. Recovery could come if regulatory clarity emerges, interest rates stabilize, market sentiment improves. Risk management. Smart strategies include holding cash reserves, reducing leverage, diversifying holdings. If you like this video, don't forget to like, share and hit the subscribe button. Stay tuned for more exciting videos. Thank you.